Hi, good evening and greetings of the day, students, friends and professional brethren. This is a small capsule which we have prepared to spread awareness about the elective paper which ICAI has put up in the final curriculum called as International Tax. It's a very bold step ICAI has taken based on the demand of the industry, the investments coming into India and investments going out of India. Almost every office of a chartered accountant today and every corporate deals with foreign exchange coming into India and going out of India. People going from India and providing services outside India, expats and foreigners coming into India and rendering services in India. This international tax paper is going to have a lot of implications as regards a student, profession and practice. We will be taking up the exact details and how this particular paper is going to help upcoming chartered accountant, people who are already in practice and people who want to get into this field. We have a small presentation on PowerPoint based on something happened 5 years back in some country, and one of the giants, which is Starbucks, was involved in it, and other giants were also there. Amazon, Google, Apple, all are there. I have taken up the case of Starbucks to give you an idea about what ICAI wants you to learn, the strategies, the compliances, the procedures which one has to understand and adopt in an international transaction arena. We'll get into the presentation and then come back and talk about the aspects of this paper for an aspirant who wants to take this up as an elective. The PPT we'll get into. The presentation is on morality of taxation, whether tax planning is justified and does tax planning result in tax evasion. Big giants have gone into what they perceive as planning, but has been considered by the state authorities as a tax evasion, a substantial erosion of revenues, wiping out their tax bases and shifting profits from a higher tax jurisdiction to a lower tax jurisdiction. Let us first get into some principles of what taxation stands as in the present era. It's a very simple concept that if you have carried out economic operations in a particular country and based out of that economic operations, if you have earned income, the country in which the economic operations are carried out should effectively reserve the first right to tax that income. That means the income would have a nexus to the geographical region in which the operations were conducted. However, these big giants, supported by big consultants, did generate profits in particular geographical region, but artificially shifted those profits from a higher tax jurisdiction, a geographical region which levies higher rate of tax, to a geographical region where lower rate of taxes were there, and effectively carrying out no economic operations in that particular jurisdiction. We'll try and analyze this, keeping in mind that an international tax transaction or an international transaction now is no longer a necessity, is no longer a luxury, but is a necessity. We are aware that economic resources, whether natural or man-made, are disproportionately distributed over the globe. For example, there is a scarcity of oil in India, whereas oil is in abundance in Middle East. So getting oil is no longer a luxury for India, but a necessity. You cannot afford not to take it. Consequently, it becomes imperative for a country to carry out transactions with other country, whether it is goods or services. Keeping this in mind, that an international tax in the present century and going forward is unavoidable, we are into it and understand what corporates have done, resulting in a big mess. Let's take the case of Starbucks. There are many of them. We are taking up Starbucks. The existing principles which I spoke about primarily talk about taxing the profits in that jurisdiction in which the economic activities were carried out. So, for example, if a person from Netherlands comes into India and carries out an activity generating income, then the Indian government should have a first right to tax that income, and then perhaps the Netherlands government may also tax that income based on the residential status of that particular individual. This gives rise to double taxation of an international transaction, where a particular income in hands of a particular person is getting taxed in India because the economic operations were carried out in India, the source was in India, and may again get taxed in Netherlands because that person was a resident of Netherlands. To avoid this double taxation and to promote international transactions, the countries went into a concept called signing of tax treaties to avoid double taxation of the same income. But although the treaties were made for the purpose of avoiding double tax, it effectively came into planning whereby you will see the corporates entering into transactions making double non-taxation or lower taxation availing treaty benefits. Let's take the case of Starbucks, for which I built up a case study to make you understand what happened and what lies forward after this. As I told you, Starbucks was founded in 1971 way back and was formed in Seattle, US. It started its business by merely selling coffee beans, then went into roasting business. Unless it was in 1986 that company decided that we shall open up a store where not only we will sell coffee beans, but also we will sell brewed coffee and ready to drink coffee. Post that, it has opened up centers across the globe, country after country, including India. You now have a Starbucks presence in India as well. And therefore, I chose this as the right topic for you to understand the implications while sitting in India, even though the entity is based out of India. Starbucks opened centers after centers, earned huge profits. It told its investors that it is earning substantial profits, and therefore anyone who invests in the Starbucks entity will get good dividends and good return on its investment. At the same time, so far as the governments were concerned, Starbucks was reporting either nil profits to them for tax purposes or no profits at all. Let's take the example of United Kingdom, which created a big furor. In India, this issue has not yet come into light, but it has already been taken care of by other countries, and India was also a participant of that. The first store in United Kingdom opened up in 1998, and thereafter till 2004-15, till the time this presentation and the data was available on the net, they had about 735 stores in UK alone. The entire 35 stores reported a sales of 300 crore pound, and the taxes were paid were only 0.86 crore in financial year 2012. That is the data available presently. So if you are telling me that out of the sale of 300 crore pound, your income is merely 2 or 3 crores, and therefore I am paying only 0.86 crore as my income tax, this no way justifies the operations of Starbucks. How did Starbucks achieve this? At one point it is telling the investors, see, I have such a big revenue. If you invest, you will get huge returns. And at the same time it is telling the taxman that I have my taxable income as only 0.86 crore pound and I will pay tax only on that. How did this entire thing happen? These are few datas which you can have a look over the period of time. I will take you through how did Starbucks manage this particular type of game. What Starbucks did, it had its headquarters placed in Seattle, USA. That was the headquarters. It opened up a first store and thereafter number of stores in UK. Now what it did, in order to reduce its taxable income in UK, it borrowed money from investors based out of US, wherein the monies were borrowed under hybrid instruments. Hybrid instruments would mean an instrument, a payment on which, for example, a debenture is an instrument. So if I have issued debentures, the payment of that instrument, that is interest. So hybrid instruments are those where the payments on those instruments which are made in one country is a tax deductible item and the other country it is an exempt dividend. For example, if we talk about preference shares. Preference shares in one country, say US, the shareholder who receives any amount on preference shares, US would treat that as a dividend and not tax it in US. Whereas preference shares, if any payment is made in UK, that is considered to be a tax deductible item in UK. So what it did, it borrowed money to carry out UK operations from people who were entities or associates of its own head office in Seattle. So money was either borrowed from its own HO or sister concerns of HO, whereby the tax deduction for the payments on those hybrid instruments was claimed in UK and those profits shifted from UK to US, and in US they were not charged to tax. This resulted in double non-taxation of that income. Neither it was taxed in UK because it was a tax deductible item, nor it was taxed in US because the instrument was not regarded as an interest bearing instrument, rather a dividend bearing instrument. So first step which Starbucks took, borrowing money to carry out its operations from its own associates through hybrid instruments and move profits from one country to the other country without paying taxes. Next, what they did, to carry out Starbucks operation and to supply brewed coffee and ready to drink coffee from other stores, they needed coffee beans. They identified before Brexit, before UK went out of European Union, UK was part of European Union and it was a borderless union. So Starbucks identified 3 countries in the European Union, which was primarily Switzerland and some neighboring countries, where they identified that if trading in coffee beans is carried out and coffee beans are roasted and any VAT is charged on those coffee beans, it is as low as 5%. So roasting of coffee beans attracted a VAT of 5% and sale of roasted coffee beans did not attract any VAT in that particular country. So what Starbucks did, it put up its head office for purchasing coffee beans and roasting coffee beans in Switzerland. And it purchased coffee beans across the countries which were roasted in Switzerland, paying a very limited VAT of 5%. As against, if the same activity was carried out in UK, coffee beans were purchased and roasted, the tax on that, the VAT component would be as high as 25 to 30%. So now what they did, they made Switzerland as their center for purchasing coffee beans and roasting. Once the coffee beans were roasted in the Switzerland entity, they were supplied to UK entity at only 5% VAT. This also resulted in the purchase price being paid to the Starbucks entity itself in Switzerland. So the entity in Switzerland was a Starbucks owned entity which carried out roasting of coffee beans and charging only 5% VAT on supply. The purchases were done by Starbucks UK from Starbucks Switzerland, and purchase price went to Starbucks itself. This did involve a transfer pricing issue. At what price the purchases were being done, because Starbucks UK and Starbucks Switzerland both were associated enterprises. So this gave rise to transfer pricing issue. This gave rise to an indirect tax issue where the entire purchase price of that coffee beans shifted the profits from UK to Starbucks Switzerland. Next, what they did, this brand of Starbucks was effectively formed in US. But what they did, they identified another country in the European Union which was located in Amsterdam, Netherlands, where they set up a Starbucks entity in that particular country, that is Netherlands, Amsterdam. As per the Amsterdam located in Netherlands, that country has a taxation policy of charging a tax as low as 2% only on intellectual property. So what Starbucks US did, even though the brand was created and brought up in US, they went ahead and got that brand registered in Amsterdam, Netherlands, and made all Starbucks entity pay a royalty to Netherlands entity, that is Netherlands Starbucks, Amsterdam Starbucks. So for example, Starbucks UK, the stores which were opened up in UK were using Starbucks brand. For that, an understanding was signed between Starbucks UK stores and Starbucks Amsterdam that Starbucks UK stores would pay a royalty for using the Starbucks brand to Starbucks Netherlands, Amsterdam. As a result, by virtue of charging this royalty in the books of the UK stores, the profits which were earned by the UK stores shifted from UK to Netherlands, Amsterdam. And whereas if it was not so deducted in the taxable income of the UK entity, the profits of the UK entity would have been higher and suffered 30% tax. But through this mechanism, substantial profits were shifted to Amsterdam, which suffered effectively 2% tax or no tax at all. This resulted in wiping out the entire profits of the UK stores by shifting certain profits to Starbucks Switzerland and shifting some profits to Amsterdam, Netherlands. Obviously, in both cases, the recipient was Starbucks entity, and therefore being associated enterprises, this did involve transfer pricing issues and arm's length transaction. Now, what problem it created? The problem which was created was the UK government says that you have carried out substantial economic operations in UK. You have made the people of UK pay you the money. You have earned income in UK. Now, by getting into this artificial mechanism of purchasing through your associated enterprises, borrowing money from your associated enterprises, and getting your brand registered in some other country, you have effectively gone ahead and shifted the entire profits which were earned in UK outside UK, and you have not paid any tax in UK. Now, this exactly can happen in India as well. An entity is set up in India, operations are carried out in India, but through these artificial mechanisms, the profits may be shifted out of India legally, and the company may say it is planning, I am permitted within the four corners of the law to do this, and therefore I will not pay tax in a particular tax jurisdiction. The big question is this planning or this avoidance? This gave rise to a very important topic which is part of the curriculum of the international tax portion which ICA has put up. These activities resulted in base erosion. That means the entire tax base is eroded by shifting the profits or by not paying tax in either of the countries. That means the first case where the item was claimed as a deductible item in UK and was paid on hybrid instruments and was not taxed in US at all. So the entire tax base eroded, not paying taxes in both the countries. The second issue was shifting of profits from UK to Amsterdam and Switzerland. That was called as profit shifting. The government of these countries really became concerned because European Union had gone into recession. People were not getting business, not earning money, and these big businesses carrying out operations not paying taxes to the respective government. The finance minister came together and put up a project through an organization called OECD, Organization for Economic Cooperation and Development. That organization initiated a process that how this can be stopped. The process was named as BEPS, Base Erosion and Profit Shifting, in short called as BEPS, which is now finalized and countries have approved. India has also agreed to BEPS action plans and is an observing country to all the actions which OECD carries out. Now, if similar activities are carried out in India, you placed in India will be concerned how to strategize this, how to manage this, how to go ahead with international transactions. Having said that this is happening in the international arena, not only Starbucks, Amazon, Google, Apple, all are involved in various mechanisms using various countries, starting from Panama, starting from Bermuda, going up to Manafile, going into BVI, British Virgin Islands, and so on. Now, you based in India, Indian investments are going out and foreign investments are coming in. Your office as well will be exposed to foreign exchange transactions, which not only involves income tax, but also involves FEMA. You would be required to explore and understand how treaties are to be interpreted, how treaties are to be applied. There is a huge scarcity of skilled manpower in this field. People who are aware of this, how to make the treaties operate, how to plan within the treaties, how could legally stay within the framework and still carry out a planning with the taxes to be paid, appropriate taxes in appropriate jurisdiction, pricing at which the transaction should be carried out, arm's length, etc. Now, all this would be part of the international tax curriculum of ICAI. Given the scenario that every country is now suffering from these plannings which people are doing, the government is becoming more and more stringent and laying down more and more procedures in place. They are laying down protocols to be followed, reports to be submitted. The latest one is country by country reporting in order to check the transfer pricing transactions, whether they have been adhered to the regular transfer pricing norms. So as a student, as a professional, as a practitioner, this particular area is now a very new area. Very few people are involved into it. Those who are not fully equipped because of their limited exposure. 10 years back, we didn't used to talk about such transactions, country carrying out transactions with each other. So there were very limited scope. Going forward, this is the demand of the industry, this is the requirement. What I have given you is just a flavor of the curriculum what ICAI wants you to learn. It's very practical and very subject oriented. It is strongly advised that given an elective option, one may consider choosing this, although it may appear to be a little challenging, but it is worth taking the challenge because it is highly remunerative. The moment there is a scarcity of a professional in this area, to my mind, you would be picked up like a hot cake for carrying out an employment or your own practice. There are more to it. This is just the tip of the iceberg because it's a small study capsule which we have tried to put up. We may come up with more capsules. You may try and analyze yourself. out of your curriculum which one is more remunerative, because the idea of elective is to specialize you in a particular area rather than making you master of all. So if you are specializing in international taxation or you want to get into this area, this paper is something which is really going to help you. Thank you for watching the video. If you have any queries, please get connected to Yashesh at the given numbers. They would provide you all support and help and guide you as to how to go about in selecting an elective and which elective to choose, which to follow, and which one is best suited to you. Thank you so much.